Canadians are falling into debt traps. That's right, from East Coast to West Coast, every single province has homeowners saying that the rising cost is just terrible. Now, these are a couple of articles which says that Ontario's mortgage delinquency rate nearly doubled in the last months of 2024. Now, this is just contradicting to what exactly the Bank of Canada says, that because of lower inflation, we are going to be lowering down the interest rate. Apparently, even in December 2024, because even if they lowered down the interest rate, it was not really helpful for homeowners because their payment have just gone through the roof. They have really taken out other means to pay their debts, which is, maybe lines of credit, would be credit cards, would be n number of other things. Now, let's look at another article which also says that in Canada, there is about a debt of $2.56 trillion in 2024. Now, isn't that mind-boggling? There was another article that said that Canada was on top in the G7, having the highest amount of debts in 2024. What exactly can we do on how to lower down debts, how to lower down our payments? Gap is widening between stable Canadians, those who are struggling with debt. What exactly do these people who have stability know which others don't know? So in this video, I'm going to educate a little bit and show you how exactly can you save yourself from that higher mortgage rates, higher payments for your debts. So keep watching. There are many people who are in debts, $100,000 in credit card debts, $100,000 in personal debt, $100,000 or more, $500,000 in your mortgage. A lot of debts that people have unfortunately taken on themselves because of poor financial choices. In this video, we will try and see how exactly can you solve that. There are companies who is going to sell you that fact that they are going to take away all your debts, 80 to 85% or even 90% of your credit card debts or whatever. So don't fall into that trap, because that is going to lead you into a path of consumer proposal or bankruptcy. Where is going to take you that in the next coming 2 to 3 years, 4 years, 5 years down the line? You don't know. When exactly is going to get abolished from your credit score, credit history? That's going to take time. That's going to be abolished when you pay off that debt. Yes, they would say that 80% they would take out, but still you will have to pay that 20% in order to get out from that consumer proposal or bankruptcy, right? So if you have declared bankruptcy, then the next 7 to 9 years, good luck, because I don't think so there would be any bank or lender who would be able to do that, provided you go for alternative lending, which is not the top banks. They would definitely charge you a little bit higher interest rate. But yes, we do have solutions for alternative lending. My advice for those people who are in that scenario is that take a shorter mortgage term, say 1 year term or 2 year mortgage term, so that once you work towards improving your credit, you can graduate yourself from the B side, from the alternative lending, towards the banks, towards A lenders who have the best interest rate, right? So at the time of renewal, you would not have to pay such hefty interest rates. So just be careful, don't fall into those traps, because it may sound as, very good, nothing is free in this world, so just be careful. So here is the real solution on how exactly we can offer you that lower monthly payments for your debts. So stick around. Basically, 5 smart moves how you can do it. First of all, there's no brainer. You're watching this video because you're a homeowner. You want to lower down your monthly payments. So if you have a house that has increased in equity, that you have paid out drastic amount of mortgage, we can use that equity to consolidate all your debts. Basically, use whatever is your credit card loans or whatever, let's say $100,000 combined, we can put that inside your mortgage, provided it accepts the income to debt ratio what you have been in, provided you we stay within that limit. Second thing is that you need to have a stable income. Now, be it via business income, be it employment income, we need to show an income that supports this amount of mortgage, right? So the basic rule of thumb here is that your income should be 4.5 to closer to 5 times to be on the safer side, to know, okay, if you have, let's say, $100,000, you can possibly qualify for a $500,000. Easy math, right? This is just simple, but it's not as simple. You just always have to do a pre-qualification or pre-approval letter to know what exactly your amount is that you have to qualify. But I'm just saying, as a rule of thumb. So if you don't show the $100,000, you won't be able to qualify for $500,000. If, let's say, you're a business owner and you're only showing $20,000 in the last 2 years, there is no way that we can qualify you for a mortgage for $500,000. And if you want to stick with an A side, big banks or banks that give you best interest rate, that there's no way that we can do that. We can possibly do that on the B side. So like I mentioned in this video before, on the B side, yes, there is an option. 3 is mortgage refinancing. Once you have your house, once you have confirmed that your house is worth this much, once you know what exactly is your income, we can see that yes, we can qualify you for a refinancing mortgage. So there's 2 ways to do this. One is switch or transfer your mortgage, which is at the end of the renewal term. Let's say March 2025 is the end of your renewal term from your bank, the bank that you've currently been with. We can easily switch it to another bank. The main couple of reasons that we do it is because your current bank, 99%, they will not give you the best interest rates that's going on in the market. They would just assume that you're lazy enough to not research and just sign the waiver of document and just stay with them. So that's the reason why they take that chances and not offer you the best rate. So always at the end of the renewal of your mortgage, search around and see what exactly are the other terms and other rates that people offer. You do that, you do the switch, you don't increase your balance of your mortgage, you get the best interest rate in the market, right? But on the other side, let's say you have not reached your renewal date. You are basically breaking your contract, breaking your mortgage, which means that before the end of the term you have signed, let's say you have signed for 2020 from 2025 to 2030, 5-year contract, you have signed up for that and you want to break it. So meaning that you want another bank to take off this mortgage. So there is going to be a hefty penalty because you have not even started your mortgage. Going to be breaking your mortgage even if even before it's 50% timeline in there. Most likely, let's say if you have covered 2.5 years or 3 years, your penalty is going to be much more lesser as compared to someone who is trying to break their mortgage who has not even completed a year or so, right? So it all depends on what exactly are your terms and conditions. If you are one of those person who has stuck with a variable rate mortgage, your interest rate is going to be much lower as compared to the fixed rate mortgage. So always ask the bank and see what exactly is your penalty, and from that we can do the numbers and see if breaking your mortgage would be a better thing or not. Number 4, breaking your mortgage and knowing your numbers. So with the penalty numbers in place, let's say you're one of those person who's not renewing, but you're doing a refinance. With the numbers in place, let's say, do you have any other debts? Your car loan, your credit card loan, anything that you want to plug into your mortgage. This is only if you have the income and the equity to prove that you can do that, right? So we can plug that in. And even if you don't want to do that, let's say at the time of refinancing, let's say you want to do like a home equity line of credit, we can do that provided you have 20% that's paid off, right? So if you don't have that, then refinancing is not an option, because many banks who do refinancing, they want to see that, okay, we are taking a mortgage on the 80% of your property value. $5,000 towards your mortgage, $2,500 towards your car loan or something else, or personal loan or whatever. How exactly we can lower it down, combine it, consolidate this into your mortgage. Why do most people opt for consolidation into their mortgage? Because your lines of credit would have an interest rate of 12% or 10% or 9%. Your car loan would have an interest rate of 6%, of 7%, or 8%, right? But your mortgage, when you consolidate it, it would have the prime rate, which is 5.2 right now. So that's the reason why you pay lesser when you consolidate all that into one payment, and you don't keep on paying a couple of other three or four or five payments a month, right? So that's one of the reasons why most people go for consolidation. For even debt consolidation, there is a limit. So like I said, debt to income ratio, income to debt ratio, that is a crucial point to consider whenever you're doing a mortgage, whenever you're doing refinancing. There are certain ratios that you have to fit in. If the ratios that you have to fit in, not all debts might be paid off. If that is something that is feasible option for you, then yes, go ahead for refinancing. If not, then maybe we should revisit the refinancing in the next 6 or 7 months when the interest rate has gone down, or once your penalty has lowered down even more. Because every 6 months or more you stay with the same bank, your penalty is going to be lower. Let me give you a proper example of what I did with my clients and how I helped them to lower down their payments by 50%. Clients had bought a property with us in the range of $650,000. So the remaining mortgage was about $625,000, $624,000 in this. As you see on this report, the current term, the rate was 5-year variable, 5.5%, in which they changed to fixed 4.99. 3 years. They just had 3 years remaining in their mortgage, so they didn't want it to extend it. They just went for 3 years, 4.99%. Right, and this was done earlier in 2025, so 4.99 was the consolidation rate. Right now maybe we can do a little bit better, but look at that monthly average amount. It was $10,367, which had lowered down to 50%, cut into half basically. $5,140 was the proposed solution that I've advised them, and look at that results. That has given them a total savings of $18,000. That means that your current interest, had you kept on paying that $10,000 a month, your current interest for all the debts would be $134,900, basically $135,000, and the newer mortgage terms would have taken only $110,000, which means if you talk into payments, that has lowered your payment up to $5,227 a month. That's obviously a huge savings, basically about 50%. So my client was really happy. And look at this, the break-even cost. The break-even cost is where exactly you would cover your refinancing cost. Let's say in this case it was penalties and all other admin fee. There was a $3,000 capitalization thing that we were able to do into their mortgage, but apart from that, the client had to pay from whatever was remaining in their penalties. I gave them this report and I showed them, this is what you can do even before they signed up for their mortgage, and they were really happy that they were able to consolidate that. Now these guys are investors. They did this for one of their property, and they wanted another property of theirs for me to do the same thing, but instead of consolidating all any of the debt, well, there is no consolidation remaining because we consolidated everything in this. We basically increased their mortgage from $624,000 to $840,000. That was $1 million property, so we were able to do that. They were asking me to do a refinancing for another property. So do a refinance in such a way that I can do a mortgage and a line of credit and use that line of credit to buy another property. So a lot of tips and tricks on how exactly you can leverage the financial knowledge that you have from an amazing mortgage brokers of yours. So stick around, lots and lots of information coming in the next few days. If this video was helpful, like, comment, and share it to somebody who would absolutely benefit from this video, and see you in the next video.